Yesterday, AMC got a short squeeze type 3 rating. This, on average, has only happened 3 times a year and has been remarkably accurate in predicting when actual rallies happen in AMC stock. Now, if you guys haven't been to the channel in a while, then you might not know, but the data is looking to support a short squeeze is in fact right around the corner. Now, here in this video, we're going to talk about where that could take AMC before the reverse stock split, granted if it does go through, and after the reverse stock split as well. So we have a lot of ground to cover in a very short amount of time. Hit that like button and subscribe to the channel. If this is your first time here, consider sticking around a while, baby. Especially if you like AMC or you like broad market concept, trading concepts. We cover all of it here on the channel. So yesterday, we got a short squeeze type 3 rating. We got one of these during the March rally, like before the stock went from 20 to 40. So that was a pretty good reading. We got another one back here on August 4th when the stock was around $8-9 per share. And then the stock went dramatically higher than that. We got another one before the rally in November, where that was the smallest rally overall, but it was still like a 100% rally from the point we got that short squeeze type 3 rating. And you got another one on Friday. So tends to be pretty positive indicator, and after these returns, you tend to get around a 30% profit. Now, obviously, this data is skewed by some bad ones, good ones, right? But you tend to get a pretty big reaction after these indicators do get put out. And this is one of the most significant indicators that you could get for a short squeeze kind of trade. So that's a very positive thing. Now, if you guys did not watch the last video, then you might not know, but we have a lot of failure to delivers that will be coming due as well in this next upcoming week. And you're going to have 1.8 million shares on Tuesday, 1.7 million on Wednesday, 700,000 on Thursday, 800,000 on Friday, and then even the week after that on Monday. Not this Monday, but next Monday, you're going to have over 500,000 shares that are in failure to deliver status. Tuesday, 2.1 million shares. Wednesday, 1.5 million shares. Thursday, 1.5 million shares. And Friday, 1.3 million shares. And the price difference of where these failure to delivers actually occurred is substantial. AMC is over $6 per share currently. These FTDs occurred mostly in the high $3s, low $4 price ranges. So these hedge funds, these market makers, they're way upside down. If they did not get their shares they needed to oblige for these options for, usually it's options, 35 days ago, well, the stock's a lot higher now. And this can all help to push AMC up very dramatically, considering the volume has not been all too high as of recently. It's certainly not the 100, 150, 200 million shares that we were used to seeing for a while. So you definitely are seeing FTD spiking up to levels in which you've seen in May of 2021 before the June short squeeze. You can call it a gamma squeeze, a short squeeze, whatever you want. Shorts really didn't cover in a huge way, and that's going to be a main point of this video, because shorts did not cover in a big way back in June of 2021. And I think the reason for that is very obvious. From a short seller's perspective, or just from your perspective, if you've ever shorted a stock, which I'm sure a lot of you guys have not, but stocks go up, stocks come down. So why would anyone have to cover on their short position if their short was going against them and the stock was going through a short squeeze? Well, it's because they didn't have the margin to put up the capital required to remain in that position. And that's it. Nobody just comes knocking on your door or your trading brokerage and say, yeah, guys, we need you to cover on that short position because the stock's going up. No, they say, hey, stock's going up. You got a short position against this stock. We're going to need some more additional collateral in case this thing gets out of control. Fair. They send over the money. All is good. They can wait out the storm until the short squeeze ends and the stock comes down. Boom. Never had to cover on their short positions. But more important than even that is the underlying business. If you're over here shorting Carvana and it goes through a short squeeze, or Bed Bath & Beyond and it goes through a short squeeze, you're more likely to ride out that storm and not cover on that short position because overall the business is going bankrupt. Both of them. They're donezo. Eventually you're going to make all of that money on that short position. It might take a little bit of time. You might have to ride through a little bit of squeezy McSqueezy, but at the end you're going to make money on that trade. Even the same was for AMC in June of 2021. It looked like the company was going bankrupt. They were going to have to pull something out of their booty holes to remain in business. And in fact, they did. So why is this time different? And what ultimately drives the decision to cover on a short position instead of riding through a short squeeze? And that's the main concept I really want to get across to you guys here in this video. The main difference is fundamentally, where is the business? Is it going to get better from here than it did, call it last year or the year before that? Or is it going to get worse over the next coming years? Is it going to go bankrupt? Yes or no? The obvious question and the obvious answer is going to be no bankruptcy for AMC. Obviously, with the things that they're doing with the reverse stock split, all of that kind of neutral, I would say, for the overall share price of AMC, but it unlocks a lot of fundamental value for the company. So this time around, you're in a much different place. Even consider the box office for 2022 compared to 2023. Yeah, there was a couple big movies in 2022, and that's what really drove the whole box office. But in 2023, there's going to be a lot more films. There's going to be a lot more reason for people to go to theaters, and I think that translates well into AMC in 2023, specifically AMC earnings. And I think even Q4 earnings 2022 are going to be really good. So this time around, when AMC does start to squeeze, the deciding factor of covering on your short position, let's go back to what I just said. Is the company going to go bankrupt? Are the fundamentals going to look better in the next 12, 24 months than what they currently look like? And I think the overwhelming answer now is AMC's not going bankrupt, and the fundamentals are going to look a lot better. So from that perspective, a stock might be able to hold up its short squeeze levels a lot better if you're a stock like AMC compared to a stock like Bed Bath & Beyond or Carvana that is almost guaranteed going to go bankrupt. So what we seen in June of 2021 was the short interest, let's see, it might take a second to scroll down here. We did see the short interest go from 24.49% on, this was May 28th, right before the rally in June, down to a low of 14.76% June 30th. That was after the short squeeze had happened, when AMC was on its way down. That's not really indicative of a huge short squeeze, at least in my personal opinion. At this time, you did have 102 million shares that were sold short. Currently, you have 118 million shares sold short. At the lowest point, you still had 75 million shares sold short. So you roughly had 27 million shares that had to get covered by hedge funds because they just weren't in a good place, right? They didn't have the capital to remain in that short position. That's as simple as it gets. That's the only reason why you cover when a stock is going through a short squeeze. This time around, if you can't tell from the drift of this video, I think it's going to be a lot different. And I do think you're going to see shorts much more inclined to actually cover on their positions due to the fundamentals actually increasing. Now, the live short interest of free float is at 23%. Cost to borrow max at 1,000%. Cost to borrow average at 444%. And cost to borrow minimum down here at 7.26%. I would disregard that. The last real reading that we got was about 400% with the cost to borrow minimum. And Interactive Brokers has us at 385% cost to borrow rate. So somewhere in between 385 and 1,000% is where most brokerages have their cost to borrow rates listed. Now, AMC is also, like we discussed, on the threshold securities list. So that means people are put on notice. There's a lot of positions, a lot of shares that need to be accounted for, that need to be delivered to the rightful party, and that's going to mean market makers and hedge funds buying the stock in the millions over the next coming weeks. Same time as all of this is going on, you're seeing AMC at a very important technical level, breaking almost above its downtrending level of resistance. It broke above that on Friday until the markets completely deteriorated. And what you've seen intraday on Friday was a very bullish start on AMC. So one of the things that makes me most excited about AMC out of all of this, forget the short interest, forget the threshold securities list, forget the FTDs, forget just everything I just said. Just wipe that out of your brain for a second. The most bullish thing for me is that I think shorts will actually cover on their short positions this time around. In June, it was mostly a gamma squeeze. Let's be honest. It was mostly a gamma squeeze. 25 million shares covered. I mean, that didn't cause this move that we've seen. It was a lot of FOMO. It was a lot of, gamma, right? Small portion of shorts actually covering. But what is similar now compared to June of 2021 that this was not the case throughout 2022 is the loosening of financial conditions. AMC, when the markets are in loosened financial conditions, tends to perform much better. Like the beginning of Friday, the first half, AMC was off to the races. It was doing exceptionally well until the market started to deteriorate. And then so did AMC. And I think the fact that you have earnings out of the way, that risk is gone. Fed Jerome Powell, that risk is gone. I don't really expect inflation to go up. I don't really expect any of the economic data to come in really bad and give you a huge, burst of fear over recession. I just don't think that is logical right now. Maybe Q2 or maybe down the line. But as of right now, the market environment looks a lot more capable, I should say, of rewarding AMC if we do go through a short squeeze. So, where would I expect AMC to go? Okay, so pre-split. Let's say we go into a short squeeze next week, or the week after that, or whatever. Before March 14th, before the conversion day of APES into AMC, and before the reverse stock split. Well, I could easily see the stock going to new highs. Now, if we do get this conversion, AMC does pay off some of its debt. Sure, it'll mean a little bit more dilution in the short term, but I think it fundamentally makes the argument from hedge funds, do I cover on this position or do I not? I think it makes that decision a lot easier, right? Let's say AMC does pay off all of its debt. It ain't going bankrupt. It's going to be just fine. Well, in that case, I do think AMC could reach some astronomically high levels. And I do think AMC could hit hundreds of dollars per share. I think it's really hard to say at that point. If everything went smooth, $100 to $300 at the very least. It's very hard to say what would happen, but and let's be real, the reverse stock split, and I'm talking for these current levels, right? Seeing the stock go from $6 to $100, $200, $300, that's very good. If we get the reverse stock split and the stock starts to trade around $50, well, you could easily be talking over 1,000, right? You could easily see a 10 to 20x in this stock from my perspective here. 30, 40, 50x, that's also very possible, because what actually affects short squeezes the most is not where the short interest goes from 24% to 14%. That doesn't give you that much of an increase. What does is seeing that short interest go from 14 to 7. That's where you get the most bang for your buck when shorts actually cover, because at that point, you got to get out of your short positions pretty quickly if you're that underwater. So that is pretty much all for this video. Just to reiterate, I think the stock could 10 to 50x, just depending how everything does play out. I think on the low end, a 10x. On the high end, around 50x. And that's just based off the data that we see. And obviously, there's a lot of factors that go into this. How much retail momentum is there? How much hedge funds are, buying the stock as well? Do they get on the side of us? Or do they get on the side of the hedge funds and short the stock? I think for the reasonings that I've put out for you guys in this video, it would be squeezing the stock to the upside. Do they disable the buy button again? There's so many things that you cannot calculate with a potential short squeeze. At the very least, I think you'd be very happy on what happens. Now, obviously, I'm not a financial advisor. Do not take any of this as a recommendation. I am talking out of my booty hole with my own speculations. The data is certainly here to support it, but who knows, anything can happen, so do not invest based off of what you hear on a YouTube video. That is it. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section if you have not already. Please make sure you comment down below. Where do you think AMC could go? When do you think it will squeeze? All of that information is very much welcomed in the comment section. So, thank you for watching. Enjoy the rest of your weekend, and I will see you in the next one.